Hello guys, and welcome back to the channel and another update on my portfolio series where I basically talk you through my stocks and shares ISA portfolio, talk a bit about markets, exactly what's happened in the funds that I hold, and we pretty much just take it from there. So those of you that don't know me, I'm Jack. I work in wealth management. I'm a CFA charter holder, and I like to think that I know a thing or two about markets. So hopefully you enjoy the video, hopefully you take a snippet or two of information from it. And yeah, with that covered off, we'll come on to the Excel dashboard.
Just before we continue, this video is not financial advice. This is for education and entertainment purposes only.
Right, Excel dashboard, starting at the bottom, like usual. I get paid at the first week of every month, and you can see that I've contributed £0 this month. If you watched last episode or last video of this series, you'll know that that is because I'm going on holiday in a couple of weeks, and I've got another holiday to book soon, so I can't actually contribute my pay this month. I'll see what happens at the start of next month, because depending on how expensive the holiday is, I could chuck some money in, but no contributions in August, which I don't actually mind, because when we come on to talk about the markets, everything is continuing to go a little bit crazy at the moment. I mean, some areas of my portfolio aren't, which if anything makes it a good time to invest, but just the market more broadly, and if we do get a bit of a sell-off, then I would expect my stuff to get hit. Maybe less hard, but still get hit. So I'm a bit cautious about markets at the moment, which is why I'm not too fussed about not being able to add. If everything was down, then I'd be a bit more upset about not being able to contribute, but that's fine. Coming to the top then, you can see my portfolio as it stands. So we've still got the same 6 funds that we've had throughout. It's actually 6 months now since my first video or first made this portfolio, so time is absolutely flying by. But anyway, 3 funds are more defensive, 3 funds are more sort of aggressive. So the defensive ones are insurance, Fidelity, which is a UK fund, and then health and pharma. And then the 3 aggressive ones are BlackRock Global Equity Unconstrained, which is like a BlackRock Best Ideas Equity Fund, American Smaller Companies, and then a global tech fund. So that's how the portfolio is positioned. You can see that my biggest holding is Polar Capital Global Insurance, which I think started, to be fair, about 30%, but I've since added to it because it's gone sideways. I've got quite a contrarian mindset when it comes to investing. I find it quite hard to buy into momentum when everything's green. I much prefer to buy things that are down or sideways. So a lot of my contributions have ended up going into the more defensive areas because of how markets have been. But yeah, we'll come on to talk about that more when we go on to the charts shortly. Then we've got these 2 charts in the middle which show the portfolio over time in 2 different ways. So this one on the right includes contributions, which is why it's so sort of outsized in terms of the change. So obviously started at 10k, went down to basically 9 when the Trump tariff crash happened, and then we're now just under 13, which is good. You want to see that line going up over time, which is absolutely what I'd expect. And then these big jumps are the contributions, I would think. Yeah, so 900, 1,100, and then the bit at the start. This chart is almost every day we get a bit closer to looking good in terms of the gain bar being on top of the light blue contributions bar, which was my intention at the beginning. I wanted it just to be a smooth line and you could see the breakdown. But sadly, we started this series just before Trump tariffs and the big market crash, so that's why that chart doesn't look how I expected it to look. But this is a long-term thing. I'm not going anywhere, so in a couple of years that will look beautiful and we'll be sat on like a 100 grand portfolio and I'll just be sipping pina coladas on a beach somewhere, so that would be great. But you can see not actually much change in the overall value in the last month or so, but under the bonnet, I think there has been quite a lot of change. You can see just before we'll go on to TrustNet, which is what I keep referring to in the charts, which is like a software or a website you can use to plot different investments. But the biggest problem, or the biggest, the fund that has undershot my expectations the furthest has been the Health and Pharma Fund. And that is primarily because of, well, firstly, idiosyncratic stuff in terms of missing earnings and CEO changes and all this sort of nonsense. Also, you've got the macro of Trump and RFK coming down a bit on pharma and pharma prices, which has got people worried. And then finally, you've got those 2 things coming together to cause quite negative sentiment in the sector. And I think in today's market, Sentiment probably matters more than it ever has done before. You know, momentum, algorithms, Wall Street bets, all that sort of stuff. 0 day to expiry options. All these things sort of compound short-term problems. And that's why I think we're down 7.5% on what's supposed to be a defensive fund. But again, I'll come on to that now when we go on to TrustNet. So here we are on TrustNet, and I'm going to start with a 6-month chart showing the defensive funds versus the global sector. So the IA Global is all active and passive global equity funds in the Investment Association defined universe, it's called. Anything, if you've got like a group of stocks you pick from or a group of funds you pick from in the finance industry, that's called a universe. Anyway, you can see they did actually do their job in the initial Trump's tariff sell-off. So we had about, call it a 16% drawdown in the global equity sector. All of the defensive funds beat that by quite a considerable margin. So, you know, shaving about a third of the drawdown off is quite good going. And then you can see that idiosyncratic sort of healthcare story has just been completely miserable, and it hasn't bounced back at all since the tariff sell-off, and it's actually gone lower, which is not what I would expect. But again, over the long term, I'm quite confident in healthcare. You've got an unwell population, you've got an aging population, you've got, you know, innovations occurring in the GLP-1 story, constant R&D in the sector. So in my opinion, that's quite a steady Eddie long-term performer that I'm quite happy to continue to hold. And the reason I've got the index there, the passive, is because in my opinion it's sort of, I mean, it hasn't played out so far, but the large caps are where you sort of would want to be in healthcare. They do a lot of acquisitions, so yes, you can get sort of rocket ships in the small cap area, but that comes as a result of the large caps buying them up most of the time. So a great research, so maybe they print a great drug, you know, they've done their fantastic research, they've got this groundbreaking drug, one of the large companies will come in and buy that and then sort of milk the profits. If you're a small cap investor and you pick the right one, you'll make loads, but that's not really something I'm interested in. I'm more of a boring investor. And then you've got also healthcare. UK's actually absolutely boomed it, which I'm quite happy with. And then you've got insurance there that's pretty much gone sideways, which is why I'm happy to add to it. We'll just quickly show you the opposite, so the more aggressive funds that I hold, and see how they held up in the drawdown versus the global sector. And you'll see, as to be expected, they were far worse in the drawdown. So where the sector was down 16%, the aggressive funds were down anywhere from 22 to 26. But what you can also see is that the recovery was far sharper. So we've now got BlackRock and the tech fund at or above the global sector, despite having that huge drawdown. And their small caps have done pretty well. I mean, the reason that was sort of a double compounded problem in the small cap especially was because they're held in US dollars, same with the tech fund, and the US dollar was weak into the tariff announcement, so you had the equities going down and the US dollar going down. The US dollar hasn't really come back at all, so if you had a hedged small cap share class, you'd have done even better. I say the US dollar hasn't come back at all. It's come back a small amount, maybe 3 or 4%, or maybe about 3% against against GBP as a UK investor, but it's still not ideal. I would quite like to see the US dollar rebound a little bit. I was hoping for a second half rebound. We're already 2 months into the second half and it hasn't quite happened yet, but we'll see what happens. I mean, I'm looking at moving my funds actually over to AJ Bell as opposed to Hargreaves, and they don't have a lot of hedged share classes on there, which in some ways would be nice because it takes the power out of my hands. It's something less to think about, but it does restrict my freedom, if you like. So yeah, that's that. Final chart just to show on here today is the global sector versus my portfolio as a whole. Actually, I'll show one more, which is the long term, which makes me look less silly. But you can see I started the series in February, so around here, aka the top of the market, and then we had the huge sell-off. Ordinarily, I would hope that my portfolio would do better on sell-offs and then underperform on the upside, if anything. But clearly that didn't happen. A lot of that, I think, was the US dollar story. This global sector will be about 65% US. I think my portfolio is probably 80 to 85% US, so that doesn't help. But then also, I mean, you can see on the rebound here, my portfolio is significantly underperformed. And the reason for that, I mean, we saw it on the other charts, is the insurance and the healthcare has been a real drag. But what you've also seen in this most recent run up is, in my opinion, a dash for trash. And what I mean by that is there's been a lot of froth, a lot of greedy sort of sentiment, animal spirits coming into the market recently. And you can see that in things like crypto, in things like Nvidia, Tesla. You see it in the American Eagles story. Sydney Sweeney is in an ad and suddenly the stock's up like 30% on the day or whatever it was. There's clearly some elements of froth in the market, and it's in those environments where I'd expect this portfolio to underperform. But again, that's not really my style of investing. I like steady, slow, low volatility, if I can, investments that will just compound over time. So if we move over to a long-term chart, again, this portfolio wasn't in existence here, so it's a bit unfair. But can I get the COVID drop on there? I'm not sure. It's on there, but it's not really very fair. It doesn't really show what I expected it to show anyway, so that's fine. But yeah, you can see if I'd have had this portfolio for 5 years, we'd have been smashing the global sector. Some of that is backwards looking bias, i.e. I've picked funds that have done well. I haven't picked the worst funds. But regardless of that, I would be very confident, I would be 65% confident that this portfolio will outperform the global sector over the next 5 years. So in August 2030, when I upload my portfolio update number 131, we'll see how well that's come to fruition. But anyway, the reason I bring this chart up is to show you 2022. So you can see 2022, we had a big drawdown in the global sector. This portfolio would have stayed flat, if not ticked slightly upwards. And then, yeah, I am disappointed that we underperformed on this most recent downturn. Like, that's the exact environment I would expect to outperform. But we'll see what happens. I still have faith. I do think this rally is a bit overextended in the broader sector, the global sector. The S&P 500, I think it's a bit overextended. I wouldn't be looking to buy into those markets here. I'd be looking to buy into the more defensive, more beaten down areas, i.e. healthcare, i.e. insurance. So we'll see what happens over the next couple of weeks with my holiday. I'll come back looking nice and tanned. I might chuck some more money into the markets if I've got some left over. And yeah, that's that. Hopefully you enjoyed. Please leave a like and subscribe. Thank you guys a lot for all of the views and likes and the comments and stuff on the recent videos. Up to 250 subscribers now, so thank you. I'm very happy with that. And yeah, please stay tuning in. I've been loving the views, so see you in the next one.